Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to the Bloomberg Brief. Let's set your agenda.
The Bank of Japan decision caps a busy week for central bank action. The yen continues to slide. Policy remains unchanged with no clear signs of a shift. Yields march higher, stocks sink in the wake of the Fed's hawkish shift. Bill Ackman remains short bonds, while Bill Gross warns more losses to come. And the euro also under pressure today. More grim data suggesting the economy contracted in the current quarter. Danny, good morning. 72 hours that redefine the word pause. It depends which version of it you want to take. Ueda is not stepping forward with redefining the narrative of when yield curve control will be relinquished and the yen goes lower. Now your risk is this: aggressive unilateral intervention in the yen, or has Janet Yellen unleashed the hounds? In other words, allowed Japan to step in unilaterally. He warns very clearly the distance to ending negative rates has not changed greatly, and so there's more pressure, which is the yen is down, the dollar is up this morning. Now, of course, the bond market was shook to its core yesterday. 30-year paper, real momentum at the longer end of the curve, up 13 basis points. 10's trading at levels we haven't seen since 2007. We'll talk more about the bills, the bearish bills, Bill Gross and Bill Ackman, of course. The view from them, they're going right up against Alliance Bernstein, who say you're going to see a 20% drop in yields. These boys are saying, nah, we're worried about deficits, and so yields will remain higher for longer, which takes me to the oil market. There is breaking news from Russia in the past, probably in the past couple of hours, which is very clear that Russia is going to temporarily ban diesel and gasoline exports. That's 1 million barrels a day coming off the market. I like what Helima Croft had to say. This is reducing our market complacency. This is, again, reminding you about energy weaponization. Take a look at the euro at the bottom of your screen, down 1/8 of 1%. The PMIs were turgid. France is under pressure. Germany got a little bit of relief, but really we're looking at a pretty awful stagflation scenario in Europe. The euro dips. Danny, good morning.
Good morning, Manus. Here in Equity Land, I've got your check for you. It's all about the flow show, as it always is, whether it be changing in positions, possible capitulation, or cross-border flows. CSI 300, this is not what you would expect the day after the S&P logs its worst day since March, falling 1.6%. The CSI up almost 2%. This off the back of a story. Reportedly, China is maybe looking at changing some of the bans to foreigners for buying domestic stocks. The rally is off the back of that. Europe, though, Manus, picks up the mantle of that very poor flow. Bank of America out with a note saying that we have seen the biggest outflow from equity funds since December of 2022. We are not buying in this scenario, but maybe just a little bit this morning, Manus. S&P 500 futures rebound, but Morgan Stanley, their trading desk, warning of fragility in this equity market, be it because of the trend following quants, be it because of option dealers. Now, Manus, speaking of fragility, you mentioned the bills, the bond bear bills, both of them coming out and saying that they would not be buyers, that they would be selling at this moment.
Yeah, I mean, there's a wonderful image, isn't there? I mean, Bill Gross is somebody who manages to put it in perspective for you. But you're looking potentially at a third year of losses on the bond market. And there you go, Danny. I got to give this to you because do you think I could dress like that? That's the question that goes through my mind.
Manus, look, what you do on the weekend is your business, and you can absolutely dress like that, but I would recommend not dressing like that on TV. I just want to make clear, this is from Bill Gross's website. We did not make this. I just want to make that clear for everybody. He did this himself.
Yeah, can I also just qualify, it's not my chosen outfit or attire for the weekend. They threw money out of the window.
Look great
That's what
in it,
they did.
actually.
That's what they did. Look, Danny, they went like this.
Tan. You know, I also have to be honest, I saw that image on his website, and I was trying to really look how that feeds into the bond narrative. Yeah. I don't think it does. I just think he wanted us all to imagine him as Ken. I think that's it.
I think he's probably more worried about deficits than he is about anything else. The point about it is, do you step in here and buy 4.7%? Do you step in here and buy longer dated bonds if you're at a certain point as an asset manager? That is the conundrum versus Alliance Bernstein, who say, look, rates are going to go back by about 20%. Yep. You're going to see a retesting. Gross makes the point. This bond market is already priced for a return to 2% inflation. Danny, good morning.
Good morning, Manus. Yep, and also worried about the fiscal helicopter money. He talks about the government throwing out money from a helicopter. All of it has been spent. Taming it and lowering it to 2% will be difficult. All right, Manis, let's push things forward, shall we, and talk about the Bank of Japan, because it left its monetary settings unchanged, offered no clear sign of a policy stance shift. Here's Governor Kazuo Ueda in the news conference earlier today.
We are
not yet in a situation where we can see sustained and stable inflation of 2% accompanied by wage increases. So we will patiently continue with monetary easing under the current framework. After that, if we are in a position to achieve the goal, we will consider scrapping YCC and modifying the negative interest rate.
Let's bring in Martin Malone, chief economist at Aurel, on this. Martin, so we were awaiting for the virtuous inflation cycle. It has yet to really come. Ueda is saying that we're still a distance to ending negative rates. How far away do you think we are?
We're probably around 3 months. I expect actually in July they changed significantly the band to allow 10-year yields to track up towards 1%. We've moved 50 basis points in 3 or 4 months now on 10-year yields. So the markets are tightening. And the reason why that took place and why BOJ moved in July was they've been wrong on inflation this year. Inflation has risen 100 basis points this year. In America, it's actually dropped 100 basis points. So there's dramatic divergences going on between US and Japan at the moment.
Martin, good to see you this morning. I mean, you talk about where the forwards markets are at the moment. You say the one year has moved, 10-year JGBs have moved. But you would say perhaps that we need to be more aggressive in pricing, a more aggressive Bank of Japan. How do they move and they don't deliver a Bernanke-style taper tantrum? How much more positioning do we need to put into our forward positions?
Yeah, it's very good you brought up Bernanke because Ueda is the Bernanke of Japan. They're actually trained in exactly the same place, MIT. And Ueda knows very, very well about the Bernanke taper caper in May 2013, which actually led to a collapse of 20% in the Nikkei at the time. That was when 10-year yields doubled in a very short period of time from 1.5% to 3%. They are desperate not to shake the markets here, and this is why they're slow walking. Ueda is not going to preempt what's going on. Unfortunately, when we trade markets, we must preempt with our positions.
But if they make some sort of change in 3 months, if it's 3 months away, is that not shaking markets? Because the message has been very clear. We are not there yet.
The message is very, very clear, but actually it's very nuanced. And that is he can get away with saying some of the stuff that he's saying, but we have surging inflation. Like hotel prices are up 40% in the last 12 months because of the surge in tourism. And tourism surge is actually very closely correlated to core inflation measures. So he said very, very clearly the output gap is still negative, but actually the government last month said the output gap has actually surged around 150 basis points in the last 3 months. So it's very nuanced, and it's nuanced because he doesn't want to shake the markets.
Well, he just doesn't want another Bernanke moment. I have it on good authority. The trade is sell your house in Chamonix and buy yourself a snow lodge in Japan. But I'm not in those lofty echelons like you are, Mr. Malone. Right. You're a max bull. I mean, you're pumping bull on Japan. All I've got to say to you is 1989, but I want you to disqualify my bubble mania from 1989. We've chosen some of your points. Why are you still max bull?
Well, it's simply every single macro lever we look at is telling us to actually buy Japanese assets, and that is actually Japanese stocks, Japanese property. Like Japanese commercial real estate is actually on fire, whereas the world's real estate and advanced economies is the direct opposite. And it's this divergence play is the macro tailwinds, and that is the main takeaway from Japan. We've seen some foreign investors actually liquidate Japanese stocks last week by around $10 billion. This is a minuscule amount compared to their 1/3 ownership of stocks. And when we have a central banker that does not want to preempt tightening, this is music to the ears to asset prices in Japan. And I would expect very, very significant double-digit gains to be a multi-year process in Japan.
Martin, we're 148 on dollar yen. We had Matsuno, the chief cabinet secretary, saying we're watching FX movement trends with a high sense of urgency. We've had Janet Yellen give them the green light for unilateral currency intervention. Is that coming soon, and is it enough?
The intervention, I actually think, will be quite irrelevant. The intervention is for speed. It's not actually to change the direction. In America, the Fed has just set out this week that we're going to have 2%, 2.5% positive real rates. In Japan, because of the slow walking of the BOJ, they're negative too. You can drive a truck through the real rate differential in Japan. This currency is going to 200. It's just how we get there. The intervention, like we had exactly 12 months ago with $50 billion, first intervention to sell the dollar by the Japanese in 28 years. That's just to, again, like WADA, it's to slow walk, nothing else. The yen is actually on a multi-year depreciation towards the 200 level.
Martin, come on. You can't come on the show. Well, you can come on the show anytime and make a $200 yen call, because we'll put that up on social for sure. Now, look, you're not going to let the G3 are not going to allow dollar yen go to 200. Are they really?
We expect a 5% currency devaluation on an annual basis. We expect the equity market to be above 10%, probably 15% gains on an annual basis. We can have a shakeout. Like the big dollar yen move was around 18 months ago. The dollar yen move, because of the intervention, the aggressive intervention that we've seen, and because of the interest rate increase of the market rates, that has slowed down to around 4% in the last 12 months, 142 to 148. But it's a slow walking issue versus speed. Clearly, nobody wants speed.
Martin, we're going to get some more bold calls out of you. You're not allowed to leave. After that dollar yen 200 call, we got to get some more of that. Martin Malone sticking around with us. Now, coming up on the program, we have mounting pressure, as we've been talking about, on the BOJ amid that weakening yen that maybe is going to 200. We're also going to be speaking on that with Mark Dowding, CIO of RBC Bluebay, later this hour. And the CEO of Ares expects private credit markets to double to $3 trillion within 5 years. More from my conversation with Mike Arangetti next. This is Bloomberg.
It is Bloomberg Brief. I'm Menace Cranny in New York, Danny Berger in London. A quick flash of where the euro is trading right now. We've some pretty big turgid calls on it, but this is over the 2 days. Down she goes by an eighth of 1%. France, the PMIs come out this morning. Stagflation is the narrative. Is it being reinforced by France in its downturn, contracting at the fastest pace in 3 years? German downturn eased ever so slightly, the PMI at 46.2, but borrowing costs are at the highest since 2011. What is stagflation to Martin Malone? Will the euro go lower? Let's go for a 2-for-1 punch. It's better than Sainsbury's or Tesco's, the UK stores. Martin, good morning. Here we are. The debate we've had all week is what scale of stagflation we have in Europe. Your context this morning, given the PMIs, France contracting at the fastest pace in 3 years.
I think it's related actually to the sort of underperformance of China. We actually see similar weakness in PMIs in places like Japan as well, and places like Germany, very, very connected to the China. The delay in the economic recovery that we've seen and the lack of consumption growth that we're seeing in China, and that's actually knocking on effect to those. And it's also the monetary shock. We've had a 500 basis point monetary shock. It'd be actually quite shocking if we actually saw good numbers.
So are you telling me that this is something the ECB would want to see? Because surely not. This, again, as Manus was saying, is starting to scream the stagflation narrative.
Well, we have full employment in advanced economies. We've got still elevated inflation levels. And in Europe, we still do not have positive real rates. So we need to, something has to shock to bring a further rollover in inflation. And unfortunately, it's going to have through the growth factor. And that's much, much better than basically 100 basis points higher on unemployment rates.
Yeah, well, look, I think politically in the UK, one could say maybe that they're in the pause land, the ECB, very unsure. You mentioned real rates, which draws me to the next chart, Martin. Have a look at this. This is real rates in the United States, breaking 2%, up at 2.1%. Is this the additional break on the inflation narrative that the Fed wants to see, these real rates pumping higher? The biggest, do you think that they will go materially higher? What is the impact?
It's exactly what they wanted to achieve.
Yeah.
And I think it's actually relatively simple. Since the financial crisis, unconventional monetary policy and central banks have been the elephants in the room. Since the financial crisis, overall, real rates have been negative. And we can all see what the benefits of that have been over the last 10 or 15 years, which is a repricing of asset prices. Now we've got positive real rates. They're there for a reason, and that is to have a disinflationary environment. And real rates of 2%, 2.5%, that's the average of the past half century, not the last 15 years. So they've reset it to a new regime of positive real rates of 2%, 2.5%. And they're there for just the disinflationary factor that it'll bring.
Martin, here in the UK, we had Rishi Sunak yesterday announce that they would ease the transition to EVs. A lot of this has to do with cost, the cost of that initiative. Is this a government that has to come to reality with how poor of a fiscal situation that they are in right now, that they can't afford what's on the government agenda?
Well, I think this basically relates into the FX crosses that we have. The dollar is strong here because it's got an excess growth dynamic relative to both the UK and Europe. We also have significant fiscal spending in America. There is huge fiscal tightening going on in the UK, and Europe is not going to boost fiscal spending. So the growth dynamic and the fiscal dynamic are dramatically different, and the real rate dynamic from America over to Europe and the UK is also different, even though it's moving. So the dollar just has these tailwinds behind it, which UK and Europe cannot get in front of. But I think basically the move by Rishi Sunak is very, very simple. Their internal polling showed that was a good idea to do that. So it's just basically pure politics ahead of an election, which we assume is going to be in October 24.
Fair enough. Hey, Martin, I'm afraid we're going to have to leave it there. So great to have you on. Please come join us again. Martin
Anytime.
Malone there from Aurel, as always. Thank you so much. Now, coming up, we're going to bring you my interview with Ares CEO Mike Arougheti. He sees private credit markets doubling to $3 trillion in the next 5 years. This is Bloomberg.
I've been in this business now 25, 30 years. No one ever wanted to talk about private credit. Now it's all anybody seems to want to talk about. I wouldn't say it's my time, but it's
yours and others.
And others.
Yes.
We like to we share. It's not like this happened overnight. So there is this overarching narrative, I think, that's prevailing in the media and the investment world that there's this whole new asset class that has just emerged, out of nowhere to take the world by storm. And I think it's important to understand how this has happened, and that if you really go back and look at the development of the market, it's been keeping pace with a lot of structural changes that are happening in other markets. For example, if you look at the public equity markets, they've been consolidating, they've been moving to scale. The average market cap of a public company today versus 20 years ago is 500% of what it was. Banks have consolidated in a significant way in the US. There has been overarching regulation coming through the great financial crisis as well as the Basel frameworks. You've got the leveraged loan and high yield markets that are also moving to scale. So behind this what seems to be cataclysmic growth in private credit, you've had real structural changes happening in all of the adjacent markets that have set us up for this moment. Knowing that has created white space, then you have to say, well, what other structural changes are going to happen to get us to the next 1.5 trillion? Sure. Because the reality is, if all we do is finance the existing equity that's in the market, we'll get there. So maybe you should say, what is it going to take to get to the next 3 trillion? The US banking system has gone through a 2-3 decade period of consolidation. We are still massively overbanked. So we went from 8,000 FDIC insured banks to 4,000. I think the next largest developed economy in the world has maybe 100.
Right.
So we've had this slow move to consolidation. I think some of what we saw earlier in the year with Silicon Valley Bank and PacWest and others is going to accelerate kind of what I would call phase 2.
It's Ares CEO Mike Arougheti speaking to me at Bloomberg's Global Credit Forum yesterday. Man, a couple things stood out to me there. One of them, he confirmed that he thought that SVB and the banking crisis is not over, and that it will be a 2-year period in which it unwinds. Most of us have forgotten, or kind of forgotten, about the banking crisis. He sees it's still ongoing because he's still buying assets from regional banks in the U.S.
Well, you see, that's what happens. You have the furor, the blow-up, the emotional breakdown of some of these markets. And then, as he says, we evolve into this phase 2, which is quiet deal-making, where these assets are being taken off the books of various banks. You look at all the banks that are going through various restructurings that we've covered, Santander, UBS, Credit Suisse, along with a number of others. But, I mean, it was a great conversation. Do you know what I do in the afternoons? I actually listen into what you were doing. It's not a zero-sum game. We win, banks lose. When banks are in transition, it's a good time for private credit. But, of course, you made the point, it didn't just come from anywhere, did it?
No, I am also so flattered, Manus.
You're okay,
I also
Danny.
feel like you probably have better things to do in your life than watch more of me. But
right now, I'm just giving all my life, my emotion, my money, every piece of me to the brokers of New York. Good morning from London and New York. And next up, we'll have Mark Dowding, the CIO at RBC, Bluebay Asset Management. He joins Danny and I for a conversation on Bloomberg. Welcome back to Bloomberg Brief. I'm Manus in New York.
And I'm Danny Berger in London. Here's what you need to know. The Bank of Japan decision caps a busy week for central bank action. The yen continues to slide as policy remains unchanged with no clear signs of a shift. Yields march higher and stocks sink in the wake of a hawkish Fed shift. Bill Ackman remains short bonds while Bill Gross warns of more losses to come. And the euro also under pressure, with more grim data suggesting the economy contracted in the current quarter. Still, though, good news when it comes to China equities, which you maybe wouldn't expect after such a down day in American stocks yesterday. But yet we had the CSI 300 Manus finish up 2%, a report that China is maybe considering changing some of the ban of foreigners to buy domestic equities. That's not supporting Europe, of course. Why would it at all? Catching on from what the U.S. had yesterday, down about 1/3 of 1%. S&P 500 futures, though, coming back, but just ever so slightly, Manus. The S&P fell 1.6% yesterday, the worst day since March. Outflows this week, according to Bank of America, have been the worst since December 2022. And Morgan Stanley says, beware of the fragility of this equity market. It is not a good picture for risk right now.
No, well, of course, it depends whether you think there's one more jolt to come in the rates market. It's almost like a Bible, isn't it? That Bank of America, the flow show, in terms of what Hartnett actually says. For me, it's all about dollar yen, and we'll push this conversation forward with Mark Dowding in just a moment. But what you have is, of course, and miles to go before I sleep. Not that I'm poetic, but it is about dollar yen. This is about not putting any blockage in the road from Ueda this morning. He says the distance to ending negative rates is not changed greatly, and so the real effective exchange rate trashed, hit the lowest level in 70 years yesterday, and still we wait to see whether the yen burst can be blocked. Ueda says price slowdown is not quite as much, so you have 148.18 on the board at the moment. What is the next moment for intervention? We'll come to that maybe with Dowding. 200 against the yen. Dollar yen is Martin Malone's call. That is a pretty stupendous call. Yields are just coming back ever so slightly. Don't forget, yesterday was a monster day. 30-year paper up 13 basis points. 10s up 9 basis points. And real rates are now firmly above 2%. The debate is from the bond bearer bills. In other words, Bill Ackman and Bill Gross saying, nah, you know, these rates are not going to come that much lower. This price already is pricing 2% inflation for Bill Gross. More on the bills in just a moment. Crude pops a little bit higher. There is a little bit of a firming in this market. Why? Because Russia has announced a temporary ban on diesel and gasoline exports. Why does that matter? It's to remind you. It's to remind you who's in charge of the flow show in this narrative. And Russia pulling back on supply is to reduce our complacency, according to Helima Croft over at RBC. It's to remind you there is a weaponization of energy, and it's live and it's real as we go into winter. That's what the Russians have done. They've just gone, bosh. Remember us? We're here. We're in control of the flow. Danny.
Can we get back to the bills? I really want to get back to the bills, only for the sake of alliteration, right? Bill Gross, Bill Ackman, both of them are bearish bonds, bearish on the long end. One of the things both of them mentioned, Manus, and we just had Martin Malone mention too, is the spending coming out of the U.S. government. Bill Gross called it the government throwing money out of a helicopter.
Yeah, and he talks, I mean, it's just like whoosh, 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 whoosh. I'd love somebody to come and go whoosh, 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 whoosh with money to me at the moment. Deficits, 1.5 trillion for the first 11 months. And quite literally, it's that. It's whether you believe the fiscal narrative, again, Martin Malone pointed out the fiscal largesse of the US relative to the UK, relative to Europe. And that is in many ways driving the US economy. So it is about fiscal concerns, which are the dominant forces for the double Bs, Danny. But let's move the conversation along. Let's reflect back onto the dollar-yen call from Martin Malone. 200 against the dollar. That's where we're going. And Ueda does not want a Bernanke-style shock. Mark Dowding is the CIO from RBC Bluebay Asset Management. Join the fray, Mark Dowding. Good morning. Do you see any possibility dollar-yen trading at 200? Is that going to be permissible? And if so, in what time frame? Good morning.
Good morning. Well, I think a call of 200 is frankly very far-fetched. Martin's a good old friend of mine, but on this one, I think that's a bit of an attention-seeking headline. I think the thing that I would really say, if you think about the fundamentals just for a moment, the honest truth is that actually the yen is a very undervalued currency. You go to Tokyo right now, and frankly, prices are incredibly cheap. By contrast, traveling to the States, prices are super expensive. I would have my own beer index. Having a beer in Tokyo costs the same number of yen as it did 30 years ago, whereas in the US, it feels like a fortune to buy a pint these days. So the yen, you have to remember, is a very cheap currency. I think, frankly, it's just being undermined because of the policy dynamic of ultra dovish monetary policy coming out of the Bank of Japan. But we're confident that is going to change. The other thing that's been overlooked today is actually we've had an inflation print, a CPI print, which is above expectations again in Japan today. We're looking at core inflation at 4.3%. And the thing that I'd be very confident about is that policy change in Japan is coming. They'll make these policy changes at the quarterly meetings, not the interim meetings. So it's really going to be next month's BOJ meeting, the October meeting, where they look at their inflation forecasts, which is the one where you could actually see a change occur. And actually, we do hope that at some point, Ueda wakes up, smells the coffee and says, actually, we have hit our 2% inflation target.
Mark, I got to stop you there because something weird is happening. And I got to ask this to Manus. Manus, is this a new economic indicator that I just totally missed out on, is judging inflation by beers? Mark, you're the second person to do this. Manus, was it Paul Donovan earlier this week who was judging inflation based on beers?
Yeah, I wonder, is Dowding going to judge my ability to find an apartment? I'm not in the townhouse market. I'm not in the Danny Burger sector. And I'm not a beer. I'm more a martini. I'm more sort of a frisky martini at around 9 a.m. when we finish the show.
I love that. I love that,
I'm not sure I can afford martinis.
It's 10:30. It's 5:30 in New York. No martinis yet, everyone. Okay, wait, Mark. So you think next meeting is where we get something? I know last time we talked, you said, look, the carry, it's going to eat into it too much. You can't play this through the dollar yen. JGBs is where you want to be. But I look at Ueda, who says that we are still a distance to ending negative rates. So what will change next month if it's not negative rates? That's going to make you comfortable continuing that JGB short.
Yeah, so I think the change comes when you change the inflation forecast. When you change the inflation forecast, that's a pretext to make another material adjustment in terms of yield curve control. I can see that 10-year yields drift up towards 1% in the wake of that meeting. And I think that then also becomes a precursor for a move on interest rate policy, potentially at the December meeting. At the December meeting, we'd see rates currently between -0.1 and 0, going between 0 and 0.1%. And although these seem like small changes in the scheme of things, the reality is that there is importance in terms of the signalling here. And once it looks like Japanese policy is starting to turn, this will take away some of the pressure that's currently on the yen, forcing the yen to continue weakening. What we can also see is the Ministry of Finance in Japan, they're mighty upset at yen weakness. They'd like the yen to be 130, 135. And so it was interesting earlier this week, we had the Ministry of Finance reaching out to Janet Yellen.
Well, here's the question then,
BOJ.
Mark, very briefly. You're right. I mean, Yellen, any intervention by Japan to prop up the yen would be understandable if it were aimed at smoothing out volatility. So my question to you, in short, do you expect substantial intervention to quash the yen? I know you poo-pooed the 200 yen to the dollar. Briefly, do you see constructive, consistent intervention? Is that road now open, and unilateral intervention, will it work?
Yes, intervention is coming. If we move above 150, I expect the BOJ to be in, or the Ministry of Finance to be in. That will push the yen stronger, but it only will hold the yen temporarily stronger. What you really need, intervention's a short-term fix. What you really need is a change in policy here. Yeah. A change in policy is what's going to change the trend.
Hey, Mark. Stick around with us. Much more to discuss. Mark Dowding there of RBC Bluebay. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Manus, it was a tough week for virtually everything, maybe save the dollar. Let me take you into the charts for a radio listening audience. I got stocks, treasuries, commodities, high yield credit. It's all on here, and it all fell this week. Was it the Fed, or was it just this whole week of central bank action as an opportunity to take the liquidity in the markets and have some wholesale adjustments? Let's bring back in Mark Dowding, RBC Bluebay CIO, who's still with us. Mark, was this the capitulation? Was this, as you put in your notes, the decisive moment across markets? Did we finally reach it?
No, this is a small wobble, I think. This is not the big shock that we would be looking at as a buy catalyst. I think that the message is be patient. There probably will be a bigger, deeper correction at some point in the next month or two. That'll be the moment that you really want to buy. But at the moment, I think people are long and wrong. Don't jump in just yet. Be a bit patient.
Where's the biggest vulnerability? I mean, the Bible on this show is the Bank of America, the flow show. Well, it's not quite the Bible, you know what I mean? We have our own Bloomberg T-Live and Bloomberg Analysis. But the flow show shows nearly $17 billion went out the door from global equity funds. So my question to you is this, where is the biggest vulnerability, Mark? Is it in equities? Is it to another propulsion higher in rates? What would you call the highest vulnerability?
Well, I think the vulnerabilities go hand in hand. One of the issues here has been that over the course of the summer, we've seen a return of the risk parity trade. People going long of risk assets and long in duration at the same time. This week's been interesting because both bonds and stocks have simultaneously come under pressure. And I think we can see a bit more of that. It's an unwind of some of the complacency around a soft landing is what we're currently witnessing. Yeah. And so for me, I think that looking at the flows are interesting. Preempting the flows is always difficult. But I would say at the moment, because managers are under performance pressure, they're long and wrong, wait this out a bit. You could get a better opportunity to dive in than you see right now.
So risk parity gets crushed as all these assets fall, Mark. You got 60-40 not performing, bond stocks both down. What is your favorite hedge? What is the best performing hedge then in this uncertain macro environment?
Well, we've liked credit indices as a hedge because credit indices in CDS are trading very tight relative to cash bonds. So that's an area we would hedge. Otherwise, in terms of looking for hedges, it's actually quite difficult at the moment, which is why I think you want a fairly clean portfolio. You don't want to have too much invested. Cash is king. Cash is king for the time being, but wait it out and there'll be a great opportunity to buy, we think, at more interesting levels.
Okay, if cash is king, how much should I have stacked in cash?
So depending what your benchmark is, I would be at half weight relative to benchmark at the moment in terms of directional risk. I just don't like directional risk. You're not really being paid to take a lot of directional risk at the minute.
Mark, we also have a moment where the bonds yields are at their highest since 2011. Is that not maxed out either? Is the ECB not maxed out at this point? Can you buy duration in Europe yet?
Again, I think the message is you're just a little bit too early on this trade. Remember that cash rates are substantially more than long-dated bond yields. And I think you can only look for a structural rally in yields when you can start plotting a course to lower interest rates. And that's not going to happen until inflation is materially lower. So I think it's be patient, be patient. I think too many people have been premature wanting to jump into a trade too early. And as I say, when investors end up long and wrong, sometimes that portends to a moment of capitulation. And actually, the moment you really want to buy, is at the moment where everyone else is selling and going the other way.
So I suppose the question is then, what could prig that capitulation? What in your mind, what's the biggest red indicator for you that goes, actually, this is what I'm looking and watching out for the capitulation moment or time frame?
Yeah, it's the $64 million question.
Well,
I mean,
that's why you're paid. That's why you're paid by RBC Bluebay to be the CIO, buddy, and that's why I'm an anchor.
Yeah, well, for sure. But I think that in terms of picking the moment here, look, I'd be looking at sort of certain technical levels on charts where I feel that CTA funds, for example, at the moment, they're going through some interesting triggers and they may be needing to sell more stocks. Interesting. In terms of looking for a catalyst here, what I really want to see to get much more bullish is more clear evidence that actually inflation is coming down. You kind of know it when you see it, but the moment to buy is not just yet.
Yeah, Morgan Stanley's trading desk saying the same thing. We're almost at that moment of CTA for selling. Mark, my takeaway is I'm stealing the line from you. People are long and wrong. I love that. I'm stealing it. Don't worry, I'll give you credit for it. Mark, I'm owning it, and which makes it okay. Mark, hopefully I didn't scare you away. Thank you so much for joining us. Really appreciate your time. RBC Bluebay's Mark Dowding. Enjoy your weekend. Now, coming up, we're going to take a look at some of the market-moving events to watch throughout the day. This is Bloomberg.
This is Bloomberg Brief. I'm Manus Crenny in New York, Danny Berger at London HQ. Let's take a quick look at what's ahead today. Host of Fed Speak is on the deck. The Governor, Lisa Cook, hits the tape at 8:50 a.m. Eastern. The Presidents Mary Daly and Neil Kashkari both chime in at 1 p.m. Then the PMIs for the United States hit at 9:45, and we're keeping an eye on any developments on avoiding a U.S. government shutdown and the United Auto Workers Facebook Live event at 10 a.m.
Now, Manus, we're also watching shares of Microsoft and Activision in the pre-market. And that's because Microsoft's, they're both up, $69 billion takeover of Activision is set to clear its final regulatory hurdle in the UK. Let's bring in Bloomberg's Alex Webb for more on this. So what's changed at this point, Alex? It's been a long-running thing. What's finally made UK regulators potentially comfortable with this deal?
It's a big concession from Microsoft. Essentially, they've agreed to license some of their gaming rights to Ubisoft, which is a significant but smaller competitor to Activision. The concern in the UK had been different from the one in the US. It very much focused on cloud gaming, which many have predicted will be the next sort of frontier in gaming. It was in the US, they were really just focused on whether Microsoft controlled too much of the overall market. This will force them to essentially to license some of those online gaming rights to Ubisoft.
And then it's all about big data. Cisco reached, I love the name of this company, Splunk. $28 billion for a name like Splunk. Only an Irishman could do that with a North of England accent. Is it going to change? Is it going to change Cisco?
Yeah, look, I mean, Cisco's clearly trying to lean more into the sort of value-added software space. You know, historically, they were, it's kind of a network hardware company. They more software dependent than some of the other established players. They are now trying to get into obviously the hottest new space, AI generated, or it's AI analysis, which is what Splunk does. It is able to take sort of often quite cluttered data, make sense of it, and let companies generate actionable insights. So it's a pretty valuable space to get in. The price doesn't look, wildly expensive. Obviously, Cisco appears to be trading up on the news. So it will certainly beef up their capabilities in that space.
That is interesting, the price dynamic on this, because for tech deals, there's been this question of what comes down, the buyer or the seller. Is this, hey, we're finally making progress, big tech deals are back?
Well, I mean, I would think so. Look, Cisco shares are up quite considerably over the past year, so the currency of their stock is clearly, quite valuable as well. That gives them, of course, great firepower when it comes to this sort of space. Tech deals are back. Well, I don't know. If you look at ARM, they're trading close to the below the IPO price at the moment. So it isn't a one-size-fits-all thing.
So here's the thing: it's all change in the Murdoch family. Rupert steps down, the helm of the empire. He's been there for 7 decades. I mean, this is Succession live, isn't it? I haven't got to the end of the last series on the plane. 14 hours on the plane. I got through 5 of them, so I don't want anybody to spoil it for me. But Lachlan looks as if he steps up and becomes, well, the prince, the anointed one.
Yeah, it's not quite a spoiler alert for the final season of Succession, but he has been, the anointed successor for some time now. He's essentially been running the shop at Fox for a good number of years. The understanding is that Rupert Murdoch spends most of his time these days at his, mansion in Oxfordshire in the UK and monitors what's happening in the US from abroad. He's not a young man anymore, Rupert Murdoch. There was a time when it seemed like he might never step down, but the succession race, the 3 kids, the 3 eldest kids at least, Lachlan, Elizabeth, and James. Well, Elizabeth is still slightly involved with some of the companies. James, very much not so. So it is confirming what essentially everybody knew. The timing, of course, is the new thing.
Manis, you've got to finish Succession, because I just want to relate this to things in the show, and I can't.
I've only got to the point of where I've only got to the point of where he actually passes away on the plane.
Oh, Manis, that's a spoiler itself. Come on, maybe there are people out there who don't know that.
Okay, I didn't mean to do that for anybody, but all I can say is, just sort of
That's like the big thing of that season.
Yeah, I've got another 14-hour flight ahead of me. So, week 1, we didn't break anything, apparently. How did it feel driving the bus then?
Hey, look, I mean, this was, and we're ending it with Alex Webb. What
Alex
a great
Webb,
way to
tech
end the
guru
week.
to the stars.
I feel like a very comfortable passenger on this bus. So,
I love it. Hey, Alex, thank you so much for covering all things tech for us. That's, of course, Bloomberg's Alex Webb. Manis, we might not have broken anything, but did a central bank break something this week? These markets, Mark Dowding says that we're not at full capitulation, but there does feel to be something in the water.
Look, it was 72 hours that helped you understand what is a pause. Is it a hawkish pause? Is it, deep confusion from the Fed. Then the Bank of England, they want to live on Table Mountain. For anybody, go read John Arthur's piece about what kind of plateau in rates the Bank of England wants to achieve. And then the Bank of Japan comes from the school. Bernanke and Ueda, almost from the same school. And they don't want a disruption, do they? But, of course, Bluebay, long and wrong and everything. And he thinks there's a bit more risk to come off the table. Danny.
Of course, the friendship between Mark Dowding and Martin Malone being tested, with Martin Malone saying dollar-yen, it's going to 200. But Mark Dowding says that that's too far of a call. It just doesn't make sense to him.
And we had a frenzy, of course, of private credit. Schwartzman, Oak Hill Advisors, all calling, not necessarily the peak, but a growth to come. OK, you drove it. I changed the gears. Let's see if we can do it next week and keep all the radials in one place. That's it for Bloomberg Brief. Week 1, surveillance is up next.